Okay, so good afternoon again, and we'll start the session. So, what we have discussed so far is the project feasibility. Still, we are at the first lesson, and we were like discussing how type of like project feasibilities and project feasible analysis work on. So, what happens is normally, as my policy, what I'm doing is since we know all of us are busy with the peak seasons and everything, and also we have some kind of stress and loneliness because of the families and everything. What happens is, as a practice of my lecturing series, I'm like giving a quick recap session what we have done so far in the previous session. So I hope like that will be helpful. It will be supportive for you all for the today's lecture series, today's session, to understand and have understanding regarding the previous lectures and previous calculations. Like what happens in the previous, I don't know, it will happen for this batch or not, but previous batches, they have participated for the first lectures properly. And also, sorry, sorry, I'm not well these days, so I hope y'all there. Um, what happened previous batches? Well, like they have joined for the first few lessons and first few sessions continuously, and with the peak times and everything, so they left, right? So they were referred the recordings actually. So what happens was they when they refer the recordings, they have to rush through it, and they were like mainly focusing on the past papers and the calculations. What happens was since lack of touch and lack of like understanding and the theoretical perspectives and the practical application, so they were failed to understand the examiner's mindset. Because of that, what happens was they faced in a very tough period in the examinations. So what I suggested is go through the sessions. I know it's very tough while doing professional qualification with the like full time work schedule. Since with this kind of a particular peak period, it will be like giving you additional stress. I know. And so what happens is I will be recapping, and as I have mentioned, I hope you all dedicate these 3 hours you'll dedicate these 3 hours for these particular sessions and for the calculations. So we have started off with what is projects and feasibilities of the projects with the characteristics, right? So first of all, we have identified actually what is a project with a special main 3 characteristics that those kind of projects will possess, right? So with the intention, with the aiming, so we have mainly recognized how those characteristics of the project will be in line. ප්‍රොජෙක්ට් එකක් ගත්තහම තියෙන්න ඕන මේන් කැරක්ටරිස්ටික්ස් තුන මොන වගේද කොහොමද සහ ඒක කොහොමද ප්‍රොජෙක්ට් එකක් බවට පත් වෙන්නේ එහෙම නැත්නම් ඒක ප්‍රොජෙක්ට් එකක් නෙමෙයිද. So we have everything, we have identified each and every scenario by taking different examples with identifying those characteristics. So these were the examples that we have discussed in the previous week, and then we came up discussing, even though we have the project, even though a company as a hotel, right? So in the hotel and tourism sector, they were the sector which is having and came up with massive projects, right? Massive investments. So even though you have projects, it won't become a success one if you don't appraise them. If you don't go with appraising one by one, which means assessing their practicability, profitability, viability, and the feasibility, whether it is feasible to conduct, whether it is viable for go ahead with the particular kind of environmental considerations, cash flows, everything, right? So under that, we have identified feasible characteristics, profitable characteristics, and assessable characteristics like market, financial, and technical feasibilities. and then we have finalized what type of project appraisal process that can be observed in the project appraisal. Steps 4ක් තිබුණා project appraisal process එකේ. We have discussed one by one how we can originate the proposals and how we can develop. After that, with that proposal, we can identify two main project appraisal techniques. So even though we had 2-3 projects, what we have to do is we have to screen one by one, analyzing the advantages, disadvantages with their initial investment. Even though their initial investment is low, when it comes to the future time period, there might be generating losses, right? So that we are going to have a screening process to check whether their viability or the profitability or the practicability in the future periods. Based on that, what we are going to do is we are going to analyze using various techniques, right? So that we have used main two analysis techniques. We call it as discounted techniques as well as non-discounted techniques. Based on those techniques, we will be focusing on under discounting what will be the suitable project, under non-discounting what will be the suitable project. So with comparing these discounted and non-discounted, what we are going to do is we are going to accept this project will be suitable for investing purposes. So what happens is we are going to select this particular project and we are going to invest in this project. And then what happens is after investing, we are monitoring and reviewing the process. Right? Right. So we are not, after investing, we are not wiping off our hands. What happens is we are going to continuously monitor whether the remaining cash flows will be generated as we budgeted. Is there any kind of discrepancies? Right, so continuous monitoring, continuous and ongoing monitoring and reviewing is needed when you are conducting a project appraisal process, right? So then we have each and every step we have identified and explained. So we have identified one main concept which is called MISS, which is Management Information System under the originations of proposals. So what happens? This MISS will be used to screen out information from the data. That will be very helpful for the decision-making purposes of the managers, since you have so much of tasks and so much of responsibilities to carry it out. So within that, if you receive a bunch of info, which means bunch of data, so that will be clearly analyzed, right? That will be not analyzed, actually give support to analyze using your information system, but we call it as management information system, which specifically customized for the managers, right? So with that information, helpfully, what happens is management can use to make decisions with the projects that they are focusing on. So here these type of things can be considered as the functions of the management information system, where examiner will be touching you a new area, right? A new theoretical area. From this might be some theoretical question will be arising, or else sometimes examiner will be testing a practical application. He might give you a case regarding this global crises and globalizations within the digitalization. So he will ask you to analyze these data, or else he will be given a scenario. So based on that scenario, you ask to analyze by the above information with the use of MIS functions or the functions of MISs. So you should have to identify what type of things in the internal environment as well as external environment can be observed, and how they can be impact in the organizational context in the internally as well as external. So we have described and we have identified how this input will be converted to output with the process, right? And also how the internal and external factors that will affect to the organizational MIS. And then we have discussed project screening with analysis and monitoring and rating. And then we have started discussing the capital budgeting. In this lesson, we are mainly focusing on the capital budgeting, as we all know, right? So in that capital budgeting, we will be like listed out the features or the characteristics in the terms of mainly we can observe under the capital budgeting process. And then the decisions regarding the capital budgeting we have identified. Finally, we came with the investment or the project appraisal tools and techniques with the process. And started off with analysis and acceptance with non-discounted cash flows. I hope you can remember this graph. So we have two main techniques that can be categorized for non-discounted as well as discounted. Under non-discounted, we have finished it off the payback period and the ARR, which is accounting rate of return and the PBT. So we will be starting today the discounted cash flows, which will be focusing on the net present value, internal rate of return, profitability index, modified IRR, and the discounted payback period. Most in the practical scenarios, most widely used techniques is this NPV, IRR, and the PI. Right. So we will be mainly focusing on these three from the discounted and non-discounted. These both techniques will be mainly focusing on. Okay. So the same thing. So we have discussed under the payback period what is meant by payback period, the initial investment you have included, and what is the type that will be that will be going to recover that particular investment. So according to the payback period, we have identified a decision criteria where the lowest payback period should have been selected if you have multiple projects or else mutually exclusive projects, because you cannot invest each and every project because of the budget constraints. It might be time constraint, resource constraint, fund availability, or it might be the management perceptions, perspectives as well. Because of that, you cannot go ahead with investing each and every project that you have identified. What happens is you have to pick one. So how you are going to pick one based on the payback period, the decision criteria is the lowest payback period. So I have separately mentioned the advantages, disadvantages. Then we have start calculating the accounting rate of return, which basically maintaining the accounting entries. Here we have to take the accounting profit. In the payback period, we have only considered the PO or like real cash flows. We have not considered any kind of non-cash items when calculating the payback period. But when it comes to the accounting rate of return, we are not considering the actual cash flows, but what on instead of that, we are going to calculate we are going to use or we are going to calculate using the accounting profit, which means all the accounting entries have to be adjusted. So we can take the annual profit before interest and tax in order to calculate the ARR. So accordingly, ARR will be served as a decision criteria with having the highest ARR because you know ARR is the accounting rate of return. It will be giving us a return. So mainly the executives or the managers will be focusing on maximizing the returns in order to maximize the profits. So if you have higher return, so that will helpful for you to increase your profit rather than if you're investing in the lowest ARR. So that is why decision criteria will be selecting as the highest ARR. And we have again identified the advantages and disadvantages, and we have calculated some examples as well. So we have done this example and also ARR what we have to discuss, right? Okay, we'll do, this is a very simple one. We'll start from the ARR calculations because we have so much of ARR activities. We'll do from here. Exercise number 7, right? The Ocean Pearl Hotel in Phuket is planning to renovate 20 of its deluxe guest rooms to include modern interiors, smart lighting, and the entertainment systems. The objective is to increase room rates and attract high-paying international guests. Okay. So they have given us the project details, initial investment, renovation time, annual additional revenue, operating expenses, annual depreciation, straight line. So you are asked to calculate the accounting rate of return, right? So go ahead with calculations. Give you like 5 minutes. So you can work on your own. After that, I'll do. So I think I have already shared the materials with you as well. We can refer to them as well. So I have not yet received the answers. So what I can do is I'll share my Excel. So I have like prepared, and then I'll take all these information directly copy paste. So they have given us sorry. So they have given us these kind of information. Right. So I directly take initial investment, lifetime, revenue, depreciation, and everything. Right. So now we can have the so we know estimated life is 6 years. So we'll calculate uh the profits has not yet been given. So we have to calculate the profits. So we'll take this is the description, right? So initial investment, they have given it as 240, right? So we'll keep it as US dollars. So no need to mention again, right? And then estimated life of renovation we have taken, annual additional revenue. So after the post renovation, we will be having a cash inflow of 90,000 for all the years. So we can copy and paste directly. This is 0. And then operating expenses. So after this project, we will be having expense of right expense of cleaning and utilities around 20,000, right? So again, each and every year it's same. And again, we are having the annual depreciation of straight line. So in order to have the ARR, which means the accounting rates, no. So in terms of calculating the accounting profit, we have to reduce the depreciation, right? So depreciation under the straight line methods, it's 40,000. It's 40,000. Right? So we can here 0. So now we can take the profits annual, right? Annual profit. So these expenses, so we'll take total expenses over here, right? So which means total expenses is this operating expenses plus depreciation, right? Similarly, and then we can take the profits by reducing these total expenses from your what you have taken is your revenue, which will be having a post renovation period, right? So revenue minus expenses will gives you the profit annual. So this is the annual profit, right? And this is the initial investment. So now you can calculate the accounting rate of return. How you can calculate the average accounting profit, the average accounting profit can be divided by your average initial invest, right? So now what you have to do is you have to search on the average accounting profit and the average investment. So how you can calculate the average accounting profit is, right? Average accounting profit is, all the profits, right? So this first year, second year, third year, fourth year, fifth year, and the 6th year. We have 6 years, but profits will be generating only for 6 years, right? So for first year, this is first year, second year, third year, fourth year. This is 0, right? So we have to use another 1 year. 1, 2, 3, 4, 5, and 6, because initial investment will be putting on in the 0 year. So altogether, we have to use another 1, right? So your average accounting profit will be last on for 1 to 6 years, right? So this is your total profits. So your time period is 6 years. So you can take average profits. How you can take the average profits? By dividing this total profit by the number of years, that is 6. So this is your average profits. Now you have to calculate. Now you know what is the average profit, average accounting profit. Now you have to calculate the average investment, right? So what is the initial investment? Initial investment is 240,000, and time period is 6 years, same, right? So how you can take the average initial or else average investment, right? So, sorry. Now you can take the average investment is you'll take the 0th year investment plus the last year. So say same, no matter, like nothing has been changed from the 0 to the last year. So which means all the average investment, right? First investment or the initial investment plus last investment will be divided by 2. In the sense, this will be directly dividing by 2. So this is your average investment, right? So I'll be making this as a plus figure. So now you have altogether average accounting profit as 30, right? Average initial investment as 120, right? So you have to take this as a percentage. So what you have to do is you have to multiply it by 100, right? So you are going to take 30. You are going to take 30, divide by this 120, multiply by 100, right? So this is your accounting rate of return. Have you received the same answers? Right? So you have to interpret your answer. The ARR of the project is 25%, right? Which means, if you invest 100 rupees, you will be have like a return. You will be having the return as 25. The rest of, which means the rest of 75 rupees will be going as expenses or either any other kind of categories, right? So ARR of the project is 25% because we cannot choose what will be the most suitable project because they have only given only one project, right? So are we all clear? I have not received any kind of like answers. That's why I have like asked.
Yes, ma'am.
Oh, great. So we can do is I'm going to share. Okay, this is the next question. So Blue Horizons. So Blue Horizons, right? So they are also considering some project to invest and reduce dependence third-party services, gain better control over the linen quality. So they have also given us these project details in euros. So you are requested to calculate the ARR. Similar, right? Same. Give me the answers after calculating the ARR. So yes, 20% I have received the answers. Okay, so I'm not going to like prepare. Like the same thing is applicable. The same process. Just quickly draft. I have drafted. Right. So here I have drafted everything. The description. Okay. So initial cost again. This is your initial investment. Okay. This is your initial investment. It's 150, right? Yes. And then expected life of the equipment is 5 years. Okay. So 1 to 5. So annual savings in the laundry cost in the sense it's a return, right? Estimated annual savings means a return over the sales savings, right? So here it's 0. Each and every year it will gives you as 50. And then we have depreciation 30. This is 0. And then we have maintenance cost of 5, right? So then you will be having the total costs, right? So total cost will be your depreciation plus your maintenance cost. Similarly, 35 years. So sorry, 35,000. So your cash flows, or else the profits, will mention as like this. Okay. So 15 in the sense 50 minus 35. Okay. So your I directly take, right? Sorry. So I can save time. Okay. So total profits. So you can have the collection of 1 to 5 years, right? 15 into 5. So this is the total profit and we have a time period of 5 years. Now we have 5 years, right? So you will taking the average profit as the total profits, which means 75,000 divided by 5 years, which means 15,000. So your initial investment will gives you as 150,000. I'll make it a positive figure. So time period is 5 years. So what happens is your average investment will gives you the initial investment. Initial investment plus last investment, which divided by 2, right? So it's 75,000. So average accounting profit gives us 15. Average investment will gives us 75,000 into 100. So you will be getting your ARR is 20%. Give the interpretation as well. So I have stopped it from the ARR, right? So you have to give the interpretation as well. Right? So what we have is, sorry, give me 1 second. So what we have to do is we have to identify the next thing, which means your payback period, right? Give me 1 second, I'll share that as well. So that is the end of the session of accounting rate of return and the payback period, which is the non-discounted cash flow text, right? So when it comes to the, give me 1 minute, I'll open the slides. And when it comes to the net present value, right? Well, use new slide set. That will be share my Excel. That is, so when it comes to the next one, which is in the sense regarding the discounted cash flow techniques. Now we have finished it off the non-discounted cash flow techniques. So now you know that we have to focus on the discounted cash flow techniques, as here it indicates, right? So we have it's not getting shared. Right. Oops. I hope you can see my slides as well. I have shared these capital budgeting techniques here. Okay, so what now we have to focus on is here this. Now we have finished it off this part. Okay, now we have finished it off this part, the accounting rate of return and the payback. So now what we have to focus on is discounted cash flow method. So under that first method, we will be like this is so much of like a very simple method, discounted payback period. So we'll like not referring, right? And also in the practical scenarios, discounted payback period will not be using as a main and major technique. So what we will be focusing is the net present value. Okay. So net present value IRR and the profitability index will be the most using practical scenarios and also using the MIRR as well in the present context. So we will be starting from the net present value. What you mean by net present value is we will be mainly focusing on how these projects will be focusing on and how these projects will be mainly considering to calculate the present value of those projects, because we know since these projects are going for a will last for a long period, right? So because of various reasons, right? Because of various reasons, sometimes the inflation rate changes, sometimes because of the exchange rate changes, everything will be matters. So because of that, net present value have to be calculated by taking a one rate, discounting rate. So all the cash flows throughout the project period, if the project period lasts for 10 years, what we will do is we'll taking total these 10 years and we'll use a single rate and we'll convert it into a future value, right? So after that, or else we're converting it into a present value. What happens is then we have all the values or else all the cash flows at one particular period. Rather, even the project is lasting for 10 to 20 years, we have taken all the cash flows at one single point. From that single point, we are going to stand up and then we are going to check whether is it suitable for invest for this project or not. In there, we will be considering the cash flows as well as inflation exchange rates, as well as the practicability, feasibility of the studies as well, which means the projects, right? So when it comes to the internal rate of return, where the next technique where we can identify where your NPV becomes zero. You have already calculated your NPV. IRR means your NPV becomes zero, right? Why we make sure the NPV is zero, which means you don't have a present value, which means that indicate your internal rate of return. You can have a return internally if you invest in this project at NPV at zero, because net present value, because you are taking all the cash flows at one single point. එතන ඉඳන් තමයි අපි බලන්නේ whether this is suitable enough to invest or not කියලා. Then we are taking internal rate of return to check whether is it possible enough, a solution, or is it possible enough practical project to invest on in the internal perspectives, right? With the NPV calculations. And also then the profitability index. So we have the cash inflows in the net present value. We are considering the cash inflows, right? CI, as well as we are going to calculate the cash outflows. So what we are going to do is under the PI method, profitability index method, we are going to compare these cash inflows and the cash outflows, and then we are going to generate the index. right? How much represent cash outflows, or else how much of a value represent cash outflows which will be included in the cash inflows. Whether our cash outflows are enough, or else whether our cash inflows are enough to cover up our cash outflows. Or else we can identify whether our cash outflows are greater than inflows, or cash inflows are greater than outflows. In that scenario, what we can identify, what we can do, what will happen, right? So those kind of things will be considered in this net present value, IRR, and the profitability index. So why these discounted cash flow methods or the discounted cash flow techniques will be mainly considered is because of their practicability of the nature, because they are considering the time value of money, right? You know time value of money. What is time value of money? So today's rupees will take අපි නිකන් අද රුපියල් 1000ක් ගමු, right? So we'll take 1000 rupees and we'll take after 1 month or else 2 to 3 months 1000 rupees. We can take it as 1 month even. What happens if you buy a basket of or else a bunch of goods and services from 1000 rupees will not be ideally matching the products or the service or the goods and the service basket that you will be taking after 2 months. That's because the time value of money. Because there is an inflation factor, as well as there might be included in the interest component that will be depreciating your rupee value. Because of that, the value of the products and services will be goes high while the money will be dropping. That is what you call the time value of money. Today money is worth than the future money, right? So that is why we are considering the zero as your initial investment year. And that is why we are taking a present value for each and every cash flow at the sum or else at a one particular period of time. So that will be easy for compare rather using several years with several discounting factors. And also it might be very complex if you use various inflationary factors or the inflation factors with discounting rates to calculate the cash. So that is what we are mainly focusing on, the main practicability and everything of these capital budgeting techniques in terms of discounting cash flow method. Right? So are we all clear up to that point? Are we all clear up to that point?
Yes, ma'am.
All right. Okay, thank you. So what happens is it's 2:30. It's 2:30 from here. What we can do is we'll have a small break, right? And at the stretch, we will be focusing on the NPV calculations, right? So net present value. We'll try to finish it off NPV today, so that remaining is IRR and PI. We'll finish it off on the next week with some exercises, right? We'll have 20 minutes break, right? 20 to 25 minutes break and come back for the calculations at a stretch. Okay. So come back at, it's here 2:30, come back at 2:55, sorry. Okay, so we'll start after the break. This is what we were discussing about. Okay, so we were discussing about the NPV, net present value. Okay, so when it comes to the NPV, so as we all know, this is the discounted technique. Okay, this is the discounted technique that we can observe. And also, this express all the present values of the cash flows, right? So we will be having cash in the cash flows. We can have two main set of cash flows as we can identify cash inflows and cash outflows, right? CIs and COs. So cash inflows in the terms of which will be receiving as a result of income or any other source towards the organization. But on the other hand, cash outflows is resulted in the outlay of the cash from the organization to outward parties, right? So when it comes to the NPV, so we have like more than 5 years, so more than 6 year long lasting projects, what's happened is we will be everything taking into a one particular place from this cash flow, this one, and here we all take particular place, right? We all take this particular place, and after that with a one particular single rate we can compare whether to invest or not, right? So how you can calculate the net present value is we can take the cash inflows, which means inflows to the organization, and we will be reducing outwards, which means from the organization, which can consider as the cash outflows. In there, when calculating the NPV, we need a R, which means we call it as DCF, discounting factor. Because all the cash flows, we need to take a present value. So in order to take a present value, what we are using is a discounting rate, which in the simple terms we can call it the interest rate, right? So when it comes to interest rate, how we can calculate is 1 divided 1 plus r to the power n. This is how you can calculate. So actually in the examinations, only this discounting factor is given, right? Which means the rate is given, but you have to prepare this rates for the one by one year. So you have to prepare. So for that, you have to make sure you are like taking or else you are remembering this particular formula 1 divided by 1 plus r to the power n. Percentage එක දුන්නට examiner they won't give these kind of things year by year. So you have to make sure managing the time with calculating these rates for separate years, right? So when it comes to the NPV, what we have to focus is we are having a rule. What we will be focusing is whether to invest or not. So if your NPV is a positive one, definitely you can choose and invest, right? And also if your project is given you a highest NPV, definitely you can invest. Just assume we have two projects. One is having a NPV of positive 10. Next one is having minus 8, right? So you have two projects, NPV is plus 10 and minus 8. So if you have to choose between these two options, don't look ahead this minus value, just take this positive value because you are giving cash inflows minus cash outflows. If you select B project, which express you in the future period, your cash outlays will be increased or cash outlays will be greater than your cash inflows, which means you have to end up with a loss if you invest on that particular project. If you invest 1 rupee, you have to make sure that you will be losing another 8 rupees or 8 cents. If you invest on project A, you know it's a positive value no matter. So if we move forward in the future time period, you will be receiving a positive value, which means cash inflows if we are carrying out the particular project, right? But what happened, just assume again another scenario. We have plus 10, plus 12, right? So we have another two projects which will gives you both positive value, right? So A and B. If you invest 100 in project A, it will gives you 10. But if you invest in 100 in B, it will gives you 12. So in this particular scenario, you can go with B because the return, right? Which means your cash outflows will be reduced in investing project B rather investing project A. Because if you invest 100 rupees in A, you can only get 10 rupees. If you invest in project B, you can only get 12 rupees. What happens? The highest, both are positive, right? Both gives a positive value, but what happens is because of the constraints, right? You have budget, resource, finance, funds, everything, human resource, everything. Because of these constraints, what you can do is you cannot identify both to invest. Because of that, you have to choose one. So based on the NPV criteria, you will be selecting B, even though both projects giving the positive NPV, the highest NPV value is given by the 12, right? So these are two separate scenarios. And if you have negative NPVs, just forget about it. Take the positives and indicate and compare the which project will give you the highest NPV, and then use it and implement it for further reference. This is how you can identify and calculate NPV. Right here we have a calculation. Just read this and we'll start preparing this. So we have ABC Incorporation, and he's considering two projects, right? Project X and Y. What they're asking is to calculate NPV for each project because both project X and Y, 4-year project period, and all the cash flows of both the project for 4 years is given below, right? So the firm's cost of capital is given as 10%, and each project, the initial investment is given as 10,000 rupees. So you are asked to calculate the net present value of each project and determining which project the firm should invest, right? So what we can easily do is, I'll share my working Excel since this is first calculation. Just go through. And then right. So first we'll go through this NPV one. NPV, oh sorry. Okay. Exercise number, for example, numbers 5. So we have two projects. Okay. First we'll take project X to calculate the NPV. So what we have to do is first we will be keeping the years here. Okay. So both are having the project period of, both are having a project period of 4 years. Okay. So right here 0, 1, 2, 3, 4. Okay. Then we can have the cash flows. Okay. So in initial, this is this is where 0, which we can have our initial investment, which is 10,000. Okay. If it is an initial investment, what happens is it's a cash outflow. It is going outside from your organization. So because of that, we have to identify the cash outflow. But cash flows in the project for 4 years, it will be generating for first year for 5,000, second year 4,000, third year 3,000, and last year 1,000, right? Then you have to take the discounting factor. So your discounting factor is mentioned as 10%, right? So remember, in your first year, which means, sorry, first year in the sense in your 0th year, definitely your discounting factor is 1, right? You have to mention it as 1. If you want to calculate, the first year's discounting factor, right? Discounting factor, what is the formula that you have to use is 1 divided by 1 plus r to the power n, right? So you know 1 in the sense it's a compulsory figure. R in the sense, R means your interest rate, which means your cost of capital rate, which is 10%, and your N represent your time period. Okay, first year, it might be the second year, it might be the third year, or else it might be the fourth year. We cannot take the 0th year here because we know, like because in the 0 year, definitely this discounting factor will be equal for 1. Right? So you can use your scientific calculators to calculate this discounting factor of first year. So R10 divided by 100 will give you 0.1. If I add 1, it will indicate you 1 plus 1, right? So I use the first year to calculate, and I'm going to be divide the answer by 1. So I will be receiving my discounting factor as 0.909. Make sure you have to take these discounting factors for 3 decimal figures, right? You can use for 4 if your examiner will gives your end examination in the Excel basis. If not, please use for 3 minimal decimal places if you calculate it in a manual basis. Don't go with 4 decimals if you are asked to calculate it in a hand, which is a manual way, right? Stop it from 3, but if you ask to use Excels in your end examinations, you can go ahead with 4 or else 3. 3 is the ideal. You have to take at least 3. So then at the second year. So discounting factor is same. It won't change. It's similarly 10. So I'm going to check what is the discounting factor in the second year, which means we are going to taking all the figures at one particular stage, right? So 1.1 into 2 years and 1 divided by answer 0.826, right? So again, in the third year, similar calculations. For third year, it will give you 0.751, right? For fourth year, it will give you around 0.683. Yes. So you have calculated now. Okay, so now you have calculated the discounting factors. And now we can take the present values. How you can take the present value, Lamai? Here you can take the cash flow and you can multiply it by the discounting factor. Okay, similarly, you have the cash flow here, but you are going to take the present values, you are going to discount it using the discounting factor, right? Cash flow is going to be discount using the discounting factor that you have calculated based on the discounting factor of 10%. Right? So now you are done in halfway. So now what you have to do is now you can take the cash, sorry. Okay, you can take the cash inflows and cash outflows. You can take the net present value. So cash inflows will be the summation of first year, second year, third year, and the fourth year. Right, which means the inflows to the organization. Outflows in the sense your initial investment on the first, which means the 0th year. So now you can apply how you can calculate the NPV, your formula, cash inflows minus cash outflows, right? So NPV equal, right, cash inflows minus cash outflows. To arrive this, sorry, To arrive this, what happens is you have to make sure to do this calculation. So your NPV is cash inflows minus cash outflows, right? This is your answer for 785. This is not the answer actually. Here you have to mention whether your NPV at what discounting factor and whether it is positive or not. At what discount factor, whether it is positive or not. Your paper markers will be mainly focusing on this, right? NPV at 10% discounting factor, positive 7,850, right? A plus figure, or else you can mention, write it on a positive, write it in a word positive, or else you can indicate it on the like the symbols. That's fine because you can save time, right? So this is, I have calculated for project X, right? Now, just calculate this for project Y, right? Give you a little time just to make sure your hands are okay, right? Because this like might gives you some time for the calculations, right? So am I audible enough? Fine, right?
Yes, ma'am.
You can hear me, right? Okay, okay. Right. Okay. Okay, I'll work on the same. So I'll directly copy paste these things directly. Sorry, so N, this is for project not X now. Now we are working for project Y. Okay, now we are working this for project Y. So same years, right? Same years. So same initial investment, but different cash flows, right? Different cash flows. What happens is for the first year, the cash flow will be 1,000, here 3,000, and then 4,000 and 6,750. Similar, same discounting factor that we are taking. So these figures won't change. What happens is now you can calculate the present value by multiplying the cash flows with a specific kind of the discounting factor that you have taken, right? So this is the present values. Here, total cash inflows is the summation of this, whereas your total cash outflows will indicate your initial investment, which is 10,000. So NPV at 10%, the discounting factor at 10% discounting factor is again gives you a positive value of 1,000 rupees, right? We'll take it down here. So the project, right? Sorry, project here NP, okay? So project X and project Y. Uh, so this is, sorry, I have muted. So project X payback, the project X NPV is this and project Y NPV is this. Okay. Now what you have to identify is, right. Now what you have to identify is to select one project, right? So now both the projects are having a positive value. Okay, both the projects are having a positive value, but the highest positive value will be represented by project Y, right? So what we are going to do is we are going to select project Y to invest, because if you invest 1,000, X will give you 785. If you invest Y, it will gives you 1,001. So we can write what is the organization? ABC Incorporation, right? So ABC Incorporation can choose project Y rather than project X because it gives a higher NPV, higher and positive NPV, positive NPV than project X, right? So project Y NPV is rupees 1,001. Okay. Project X NPV is rupees 785. Okay. ABC Incorporation can choose project Y because NPV is this much. And why we are choosing Y is giving. So any questions? Any questions? Hope all clear. Calculating the discounting factor also clear.
Yes, ma'am.
Right? So nowadays it's not matter of calculation because like you have so much of like calculation softwares and everything. So it's very easy for you to calculate just by getting one enter or one down arrow key. But the theoretical perspectives and the way of calculation, you have to identify if there are any kind of amalgamations are needed where you are going to change. It can be either the cost of capital, or else it might be the initial investment, right? Which means this 10,000 or 10%, or else these kind of cash flows. This might not be in our uh, within our hands, but our initial investments and the firm's cost of capital are within our hands. So anyway, we can change both two factors in order to amalgamate the project's cash inflows and the cash outflows, right? So here we have one example here for three projects. So I'll give you like 5 minutes. Uh, we have 350 rupees to invest under 10% of cost of capital. So just try for the calculation. So I'll share this one. Okay. So we have 3 projects. Okay. Now we have to analyze. First, this is for project X. Okay. This is for project X. So we have 3. Okay. So here, right, cash flow and discounting factor is representing 10%, right? Here present value. So 0, first year, second year, third year, right? So the cash flow 350 for initial investment, 100, 120, 100, 120, and 265. Okay, so discounting factor, similarly, it's 10%. So no worries, we can take as it is for first 3 years. We have to use it for 3 decimal periods, 3 decimal points. So present value can be calculated. Your cash flow will be multiplied by your present value, multiplied by your discounting factor. Then you will be receiving your present value, right? So after that, you can take directly your cash inflows. So cash inflows is the summation of the income or the cash input that you will be receiving. Outflows will gives you the output that you will be focusing on. So NPV at 10% discounting factor is, we'll have to see whether it is positive or negative. So what we have to do is we have to take cash inflows and outflows separately and minimize your outflows from your cash inflows, right? You will be receiving this much of NPV at for project X, right? We'll calculate for project Y. I take this directly, copy paste here, changing the cash flows, right? So cash flows will change 135, 156, and 178. So similar, the discounting factors. So your cash flows will be multiplied by your discounting factor so that you can identify cash inflows as the summation of receivables, where cash outflows will be similar to your initial investment. Again, you can identify NPV 10% at discounting factor of a positive value around 35,000. Now we will be mainly focusing on the Z project, right? So it will be changing again the cash flows and the present values. So cash flows 155, 189, and 243, right? Okay. So this is the cash inflows and cash outflows. Again, it's a positive. So we'll take a summary table down, okay? Project with your NPV. So project X, Y, and Z. For X, your NPV is 39,000. So Y, it is 35. For Z, 129. Right? Okay, right. Let me check the formulas since I have directly taken. Okay. All right. Now you know what project is to be identified and to be invest based on the NPV, right? So based on NPV criteria, the highest positive NPV will be selected to invest and implement, and that is project Z, which will gives the highest positive, which will gives the highest positive NPV, that is 129,500. So this is the decision that you are going to take based on the NPV criteria. Are we all clear how we can calculate the NPV? This is a very simple scenario, right? Actually, you will be receiving the scenarios which will be focusing on the future lessons as well, because we will be focusing on annuities and the perpetuities. Annuities and perpetuities, and then those annuities and perpetuities will be related with these cash flows, and you have to separately identify these and calculate these type of things, NPV and everything. Hope all clear with that. And we have only one example. We'll finish it off and we'll move to the next technique, which is IRR, or profitability index, right? So group B, they are considering two investments, right, which require the same investment of 1 million. The first option is making an investment on a tool that need to manufacturing process, and the next one is preparing and expanding a land next to the plant. The group wants to evaluate the options they need to focus on under the 15% of cost of capital. The cash flows is given below, right? So initial investment is 1 million. And your cost of capital is 15%. So what you asked to do is calculate the NPV and identify which is the project to be invested on, whether it is for purchasing a tool or whether it is expanding the land. So what about the answers? I need the answer. What is the project that to be invest, whether it is tool or land expanding project? Yes, can I have the answer, please? Am I working Excel? Meanwhile, you have you send me the answers, right? So I'll also start calculating. Exercise number 7. It. Okay. Take this, right? Okay. Paste it. This is tool project. Okay. So here, 1 to 4. Okay. The cash flows 250, 335, 335, 575, 598. Okay. So here, your initial investment is 1 million, right? Your discounting factor is sorry, discounting factor is this is 15%. Okay, then you have to calculate. This is 1. Okay. And so how you can calculate 15 into 10 plus 1 for the first year? It will be 0.869. 0.869. Right? So 15 plus 1 into the second year 0.756. Just let me know whether my discounting factors are not correct, right? And plus 1 into the power third year divided by 657. Okay? And 15 divided by 100 into the fourth year 571. Just let me know whether my answers are incorrect. Right. So now here we can have your cash flow multiplied by your discounting factor. Right. So now you can take cash inflows, cash outflows like this. So cash inflows will be the summation of first year, second year, third year, and the fourth year. Cash outflows will give you your initial investment. It is a minus fee. So now we can take the net present value at 15%, a positive value, positive figure. This minus this. Okay, 189, 743. So same, I will take over here to have the next project, which is land expanding project. Right? So the cash flows from that project will be giving right, 200, 200, 400, okay, and 535, 598. 535, 598. Okay. So the discounting factors are same, and the summation of cash inflows is, whereas your initial investment will stay as a cash outflow. So NPV is like this. So now your project, right? So projects and your NPV. So your project is tool project and land expansion project. From tool project, you will be having 189, and your land expansion 169. So now you can identify which project to be invested on, right? So what is the company? Group B. So Group B can invest on purchasing the or investing the tool which gives higher NPV, that is 189,743, rather expanding the land in the entity rupees 169,153, right? So this is how the answer will be worked out, right? So this will be the project that will going to be selected. Right. So this is how you have to prepare. And I have my calculations wrong
No, ma'am,
because
because of the decimal.
decimals. That's fine. Okay, that's fine. So no need to take that much of decimals. You can like finish it off around 4. That's fine. No worries. Uh, which means 190 and 170. Okay, no worries. Correct. Great. Fine. Mm, now we can identify the next discounting factor tool, that is, right? That is your profitability index. So what meant by the profitability index in the sense, right? So now we are mainly focusing on the discounted cash flows techniques. So in there, we will be mainly focusing on your inflows and the outflows, right? Which means your returns and your cost. Because we are going to discount, we know there is inflationary factors, exchange rate factors, discounting factors that will be effect on, and also such as the external market factors. The globalization, digitalization, and everything will be mainly focusing on as well. So because of that, what happens is your project investors will be vary, or else project investing time period will also be vary, and also because of these rate changes, and also because of these main market changes or the fluctuations of the market. Because of that, investors rather depending on the non-discounted technique, that is why they are focusing on non-discounted techniques as well, which we have previously finished it off. Because of the discounted techniques, they can identify the market fluctuations because discounting factor changes as well as present value and future value changes can be focused on, right? So since in this NPV, they are mainly considered the cash flows. in terms of cash receivables as well as the cash payables, which means in the sense of the accounting term, in the cash terms, cash inflows, cash outflows. Because of that, what happens is the profit or the return, which means some kind of notional expenses, there might be and like there might be some kind of possibility to miss, right? So what happens is because of that, the economists as well as the management accountants that they will be focused on what is the ration that will be expressing your NPV towards your initial expenditure in a capital budgeting system, right? So because of that, what happens, they have directly identified this PI concept, which is profitability index concept, and that will also at the latter part, you will be identified same scenario will be occurred, which means the same disadvantage will be there because it will be mainly depending on the answers or the output or the information received from the net present value NPV. Because PI will be depending on representing it as a percentage, but will be depending on the cash inflows and the outflows that will be focusing on or that has been calculated under the NPV, right? Which means if your discounted rate will be not correct, your NPV is going to be incorrect, which means as a result, at the end, your profitability index, how much is the ratio? Okay, what is the ratio? That NPV is expressing cash flows to the initial investment. That will be incorrect. So that is a huge risk. There is a huge risk to estimate the discounting factor properly as well as the cash inflows properly with the initial investment. All together happens. What happens if the initial investment incorrect is will be affecting to your net present value, right? So what happens if your discounting factor rate changes will be affecting for the present value first, and then it will be indirectly linked with the net present value. So all the amalgamated functions or the amalgamated errors will be finally also taken as for profitability index. So that is the same scenario errors if occurs in the NPV, right? So this is the profitability index formula, cash inflows divided by cash outflows. We can multiply it by 100. So we can also represent it as a percentage. Most probably, we will be representing at a percentage, but in the organization, one no worry. So what is the thumb rule? The project which have the highest profitability index, you have to choose and you have to see that because it indicates how much is the ratio that NPV is to cash flows, NPV of cash flows to the initial investment. So which means your initial investment will gives you a higher initial investment will give you a higher cash inflows or to the organization, and what means if you invest a particular amount of initial investment, the return that will be high. So in the thumb rule under the profitability index, you have to choose the highest profitability index. When it comes to the as I have mentioned, so there are like main disadvantages in the NPV as well as PI, right? So you have to better note them down as well. I'll like share these slides with you, but the advantages and disadvantages in there we have not mentioned. So just make sure, right? Just go through and make sure you have mentioned the proper notes as well in the slides as well. You can have a short note or else you can have a like a notepad. So under that you can mention separately the pros and cons or the merits or the demerits. So here, if we move with the profitability index calculation, I share this. So which I was working in this, right? So I'll go back for my NPV calculation where I have started here, right? If I use to calculate, okay, if I use to calculate the profitability index in here, okay, I like directly copy this, okay, and paste it to here. Put this as PI, okay. Right. Okay, erase this as well. All right. Okay. Little bit more, a little bit more. Right. Okay, how you can calculate the PI here? According to this calculation, the profitability index, right? The profitability index will gives you equal for the calculation. How you can calculate this? Here you have to take your cash inflows and you have to divide it by cash outflows, right? Cash inflows divided by cash outflows. So here you can identify this as cash inflows, okay? This as cash outflows. Don't consider about the minus marks in here, right? So divided by cash inflows by cash outflows will gives you, right? It gives you your profitability index, which means if you invest in this particular project, it will be generating you 108%, which means the ratio that express your NPVs of cash flows to the initial capital expenditure is 108, right? I'll write this. The ratio, no ratio that same, the ratio that expresses your NPV, the NPV, the ratio that express the NPV of cash flows, cash flows to the initial investment or the initial capital, okay, is 108%. This is the explanation, or this is the interpretation that you have to use, right? So if you use to calculate profitability index in this, so this is your cash inflows. This is your cash outflows. Don't consider your, the negative positive marks. So cash inflows will be divided by cash outflows. We can have as a percentage this. So if you take the project here and the profitability index here, project X and Y. So profitability index here 108%, here 110%, right? So which project that you're going to choose will be based on this criteria, right? So based on the profitability index, the company need to choose project Y because it gives a higher profitability index, which is 110% rather than project X, that is 108%, right? So check whether what we have chosen under the NPV, here we have chosen project Y. So similarly, the same thing will be happen based on NPV. We have select it criteria here, criteria best project. So criteria is NPV. We have selected Y. All right. criteria, profitability index, we have also selected one. So that indicates you, right? So that sorry, should use another color. So that indicate you, so the best project under the non-discounted, okay? Sorry, under the discounted cash flow method, not the non-discounted, under the discounted cash flow method is project Y, okay? So based on the discounted criteria, project Y can be suitable, okay? So both projects, NPV also giving and PI also giving the same answer. So no matter, so we have to consider the non-discounted as well. So non-discounted cash flow is also giving you Y. So that will gives you the ultimate target or ultimate thing that will be ideal to invest in project Y. Right? Are we all clear? Okay. Right. So give me like 2 to 3 minutes, please, because it's very hard talking at a stretch and calculating the calculations. I'll drink some water and come. Just give me 2 to 3 minutes, please, right? Stay, don't leave. I'll come soon. Okay. So I'll share my screen again. So this will be the last technique. So that is IRR, internal rate of return. So here these are the examples. Okay. Uh, okay. So I have done only one calculation. So I think you can continue for the other calculations with the, I mean, you can calculate the PI for other examples as well. Just try to calculate one. It's like just simple one, right? Taking the inflows and divide by outflows, multiply by 100. All right. So now the last discounted technique is is IRR, which means internal rate of return, which means this is where NPV is becoming zero, right? We are having the discount rate which will make the NPV is zero. because we need to identify whether when the NPV is getting zero, or it can be either negative, but we can mainly consider first is zero. We will be focusing on what happens if NPV is becoming zero, whether IRR or else whether the investment is profitable enough in the future time period or not. How you can calculate IRR also depend on the NPV, right? What happens if you calculate NPV in a wrong manner? The answers will give you for the profitability index and the internal rate of return will be incorrect. So that is why the main disadvantage and the main demerit of IRR and PI is heavy. And also, highly depending on NPV is another disadvantage that we can observe in the IRR and the PI. And also, higher expertise is needed because to describe, like I have to say that in order to identify the discounting factor in a correct manner, a lot of experience, expertise, attitudes, and the knowledge is needed. Right? What happens if your discounting factor is getting wrong? All the things depend on your cash inflows and cash outflows is depending on this discounting factor. So discounting factor getting wrong means your NPV wrong. Ultimately, it is relating with your PI and the IRR. So both getting a wrong. That will ultimately you are ending up with a wrong investment in a wrong project. But your calculations, you told the shareholders or the investors, we have calculated all the discounted and undiscounted technique methods, and this is the good project that we have to invest. But the good project that to be invested is the abundant one, right? So we have to make sure each and every component of the NPV is correct, because highly dependence on the PI and IRR is depend on this particular calculation NPV. So how you can calculate the IRR is we have to take two rates, or else if you given the discounting factor as 10%, right? So 10% we will be giving as 1,000 your NPV. So if you want to have your NPV is zero, which means this will be reducing up to zero. On the other hand, you have to increase your discounting factor up to some percentage. Right? This is the gimmick. This will save your time in the examinations. Right? So if they ask you your discounting factor is 15%, right? You want to search for IRR. In the 15%, you will be having 100,000, 102,000 something, right? As your NPV. What you have to do is you have to make your NPV negative or zero. So in order to do that, you have to reduce this, because this is a positive figure. Definitely you have to reduce this. In the other hand, if you are reducing this NPV figure, how you can reduce this? By increasing your discounting factor. That is the GD. So a percentage, how you can calculate a percentage, you have to take two rates, a percentage in relation with NPVA, and you have to take B percentage with NPVB, right? So a percentage plus NPVA divided by A plus B to the B percentage. So that will gives you your NPV becoming 0. If you have two IRRs, it's like having in a very rare situation, sometimes it's very common, right? If you have several IRR rates, your thumb rule will be selected as the highest internal rate of return, because it will gives you a return. Because of that, you have to find your highest return or its highest internal rate that you should have to be invested, right? So that is the main and major parts of the IRR, right? So here, so consider the example number 5, right? Which means we have With the project X and project Y. Okay, for project X, take this. Project Y, take this 12%. Excuse me, please. You can, sorry, you can calculate the IRR. Okay, you can calculate the IRR based using these discounting factors for these two projects, right? Please try the calculation. We'll give you a little time, and after that, I'll enter for the calculation. So I'm going to share the Excel here. So they are asking to calculate. Here I just directly copy paste the example number 5, which is regarding this project X and project Y. So they are asked to use 10% for project X. Okay, we have done the calculation using 10%, that's fine. But they asked to use project Y as 12%, not the 10%. So now what happens is your discounting factors and discounting figures will be changed, right? We'll calculate the discounting factors for the first year, second year, third year, and fourth year. 12 divided by 100 plus 1 into the first year. So the answer will be 892, right? So just let me know if the discounting factors are incorrect, right? So 12 divided by, for second year, it will give you 797, right? And for third year, it will give you 711. It, for fourth year, 635. Hope the answers are correct. And this is the NPV at 12%, the discounting factor, again a positive, right? So now what happens is, so you have to definitely, okay? So if we take only one, right? If we take one, just one, we'll take one. Just skip the 12% one. So here it's 785. In order to reduce, okay, in order to reduce, or else we have to find out where the NPV is getting zero now. So we can have 15% or 18% as this particular rate, right? So just we'll go through like this. we'll use this. All right. So in order to reduce this, we will be increasing the discounting factor. So we know 12% is also not enough, right? 12% is also not enough. So we'll directly go ahead with 18%, right? So we'll go with calculations of 18%. 18 for the first year will gives you 847, right? 18 for the second year will gives you 718. Yes, it will gives you a negative or like zero value because it's a 43 still 18 divided by 100. For the third year, it gives you 608. Okay, it becomes negative, which means it will be lies between your IRR will lies between 10 and 18. It's not 12. So it can be like remaining on 12 to 18. Right, we'll have this one also. 18 divided by 100. For the fourth year, 515, right? Okay, so I'll just keep in for the moment. So now we have rate or the discounting factor. We'll directly take this is NPV. So discounting factor at 10%, your NPV is 785, right? So your discounting factor at 15%, your NPV becomes minus 554. So now we can apply the IRR equation. Okay. So a percentage, right? So this is what the formula that we have focused on, right? So this is the formula that you have to use calculation of the ARR, so IRR. So a percentage plus, so you have to take NPV A, right? Multiplied by B percentage. You have to divide by NPV A plus NPV B. This is the formula that you have to use. Okay. So we'll first of all we'll take the summation of a% in the sense. So mainly we are referring the lowest value as A and the biggest value as B, right? Lowest value as A and the biggest value as B. So a percentage is 0.1. I'll use the decimal, right? So it will be easy for me to use. And NPVA is this much. Okay, B percentage is 0.15. Okay, or else equal 15 divided by 100. Okay, so this is equal 10 divided by 100, right? Right. Here NPVA plus B is equal this plus this. Okay, this will give you 231. Now, very easy. Now, very easy. So you can easily go through. Now, first of all, like use that multiplication rules, right? So first of all, you have to use brackets. Okay, I think you have remember this, right? And then multiplication, then division, then the multiplication again, then adding, then subtracting. Okay, this is the order that you have to use when you are solving the brackets. When you're dealing with, no, sorry, when you're dealing, right? So first of all, we'll do like this, right? So a percentage plus NPVA and NPVB. So we'll first take NPVA and we will be dividing it, the both of the addition of NPVA and NPVB, right? So NPVA is this. We will be dividing it by the summation of this. Okay. So what happens now after that? We will be multiplying it by this percentage. Okay. So this multiplied by this. So this will gives you this much. And then it will be very easy for you to add this percent in this. So now you will be getting what happens here. I think my calculation went wrong, right? To use decimals. Right. What happens is, oh, sorry, I'll use this. So this into this. Okay. Okay, this into this is this. Okay. Right. And this in here, I have to add. Okay. I have to add this plus this. Right. And moving that. So which means 0.60. So which means it have to be aligned with 12% to 18%. NPVA is this much, 785. NPVA plus B in the sense, so we have to reduce. This is a plus sign, this is a negative. So we have to reduce 785 and 554. So it's okay, 231. So we have to take 785, right? So we have to take 785 and it. First, we have to take the NPVA and you have to divide it by this amount. Okay, and then you can multiply it using this, okay, which is going to be 15% and this. Okay. Now what you can do is this. Okay. What you can do is this. You can multiply by this and you can add these together. Right? This add this. Anybody got the answer? I think my calculations will be like not correct. So which will be relying on 12% to 18% because this is your PV, NPV at 10, it's 785. 12, it maintained like 413, where your IRR will have to be in line with 12 to 80, right? So this will be the range that your IRR have to be rely on. Because in where between, this is where between your IRR, sorry, your NPV is getting 0 or negative, right? So just go through that calculation again. I think my Excel calculations will be wrong. Yes. I like make sure and adjust it before sending. You or anybody has been prepared? I'll try once again here. PVA is this and PVB and A percentage plus NPVA plus B. And 85 minus 554, it's 231. Okay. What I have to do is this, you have to divide in PVA. Divide by this, right? And I have to multiply it by this percentage. Okay, 15, 8. So equal this divide by this. right? And I have to multiply it by 15%. And then I have to add 10%. Then gives you 0.61. Less than 16%. I think it's remaining for 16%. Yes. So anyone did the calculations around? It is 15.7 now, 16. Just go through this again. Rely on between these two percents. Yes. Okay, so please do the calculation and figure it out what is IRR, right? That's because I'm doing in Excels. Then here we have another example, right? So here what we have another example is consider example 7 and continue with the IRR, and so just try to calculate the IRR. Better to make it throughout formula in the which means sorry, directly you can take it on the scientific calculator. So directly you can use A percentage and A, B percentage and B. So it will gives you the C as your IRR rate, right? So yes, so that will be the end what I'm going to share. Yes, so that is the end of your project feasibility session, right? Which means we have discussed discounted techniques as well as non-discounted techniques both. So we have did the calculations as well. Next week, we'll start off with the exam question. Okay. Before starting the exam questions, we'll start with practice questions, and then we'll end up with exam question. But I hope we cannot still do the exam questions because we have not finished yet the time value of money with the annuities and the perpetuities, because previous examiner gave a combination of that. So we have to wait until we'll finishing off the annuities and the perpetuities, right? So any questions that you will be having? All right, seems there are no questions. Okay, then we'll meet from the session plan. That is the session plan. We'll have some practice questions and we'll start the next lesson, which is time value of money. We'll start from that lesson because that is another trickiest one. Your examiner is like testing, and your paper markers also very strict on that marking on that question. So we'll go ahead with time value of money. So we have enough time. So we'll have another, I guess, another 10 to 12 classes remaining. Hope it's so. We'll finish it off time value of money quickly, and then we'll go ahead with annuities and the perpetuities. And then we'll go ahead with financing techniques for a project. So thank you very much for joining today with active participation, and we will meet on the next week. Until then, stay safe and God bless you all.
Thank you, ma'am.
Okay, you're welcome.